Welcome to this educational series on crypto regulations. Today, we're diving into how the Securities and Exchange Commission, or SEC, views and regulates cryptocurrencies in the United States. Understanding these regulations is crucial for anyone involved in the crypto space, whether you're a developer, investor, or enthusiast. The Securities and Exchange Commission is the federal agency responsible for regulating securities markets in the United States. Its primary mission is to protect investors from fraud and market manipulation. The SEC enforces federal securities laws and has the authority to determine what qualifies as a security. This determination is particularly important when it comes to cryptocurrencies, as it affects how they can be sold, traded, and marketed. To classify whether an asset is a security, the SEC relies on something called the Howey Test. This is a legal framework that helps determine if an asset qualifies as an investment contract, which is a type of security. The Howey Test was established by the Supreme Court in 1946 in a case called SEC versus W.J. Howey Company. Although it's decades old, this test remains the foundation for crypto regulation today. The Howey Test consists of 4 criteria that must all be met for an asset to be considered a security. First, there must be an investment of money. Second, the investment must be in a common enterprise, meaning multiple investors pooling their funds together. Third, there must be an expectation of profit from the investment. And fourth, those profits must derive from the efforts of others, not the investor themselves. If all 4 criteria are satisfied, the asset is classified as a security and must comply with SEC regulations. So when does a crypto asset become a security? The SEC looks at several factors. If investors purchase tokens with the expectation of making profits, and those profits depend primarily on the development team's efforts rather than the token holder's own actions, it likely qualifies as a security. This is especially true when tokens are sold through initial coin offerings, or ICOs, or similar fundraising mechanisms. The key question is whether buyers are relying on others to generate returns on their investment. The SEC has made an important distinction in how it classifies different cryptocurrencies. Bitcoin is generally considered a commodity, not a security. This is because Bitcoin is sufficiently decentralized, with no central team controlling its development or value. However, most altcoins may qualify as securities under the Howey Test, especially if they were launched through token sales where investors expected profits from the efforts of a development team. This classification significantly impacts how these assets can be legally traded and marketed. The SEC actively pursues enforcement actions against crypto projects that violate securities laws. Common violations include conducting unregistered securities offerings, where projects sell tokens without proper registration with the SEC. The agency also targets fraudulent token sales and ICOs that mislead investors. Additionally, cryptocurrency exchanges can face enforcement actions if they allow trading of unregistered securities without proper licensing. These enforcement actions can result in significant fines, legal penalties, and operational shutdowns. Let's recap the essential points. The SEC uses the Howey Test to determine whether crypto assets qualify as securities. Most cryptocurrencies, particularly those launched through fundraising events, may be classified as securities and must comply with relevant laws. For crypto projects, understanding and complying with securities regulations is essential to avoid legal trouble. And ultimately, these enforcement actions serve an important purpose: protecting investors from fraud and ensuring market integrity. As the crypto industry evolves, staying informed about SEC regulations is crucial for everyone involved.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.